Most systems don't collapse with a bang. They adjust first, quietly, almost invisibly. Markets still open on time. Screens still flicker with prices. Commentators still debate yesterday's data. To most people, nothing appears broken. But beneath the surface, something fundamental has shifted. Liquidity has thinned, positioning has rotated, and the US dollar has started to behave in ways it hasn't for decades. This isn't panic, it's repricing. And repricing always begins before the public story changes. The dollar has just gone through one of its weakest periods in years. Not because of a single shock, but because markets are reassessing the foundations beneath it. When that happens, the effects don't arrive as dramatic headlines. They show up in hedges, allocations, and quiet adjustments in capital flow. Throughout 2025, the dollar weakened across a broad range of currencies. On the surface, the move looked modest, but its importance lies in what it signals. This wasn't a speculative trade or a reaction to one data release. It was the result of accumulated pressure finally being acknowledged. Debt has reached historic levels. Fiscal deficits have become permanent rather than cyclical. And the long-standing assumption that the US economy will always outperform the rest of the world has started to weaken. At the same time, policy uncertainty has grown. Tariffs, sanctions, and abrupt shifts in trade policy are no longer exceptions. They're normalized tools. As a result, global investors have begun doing something they rarely felt compelled to do before, actively hedging dollar exposure. For decades, the dollar was treated as neutral ground. Exposure was left unhedged by default because trust in US institutions and policy stability made currency risk feel irrelevant. That confidence is no longer automatic, and when confidence fades, markets don't debate, they adjust prices. What makes this moment different isn't simply that the dollar is declining, it's that the decline is happening alongside rising demand for alternatives. Central banks are no longer behaving as if US treasuries are the unquestioned core of reserves. Gold has surpassed treasuries as the dominant reserve asset for the first time in decades. This shift isn't ideological, it's defensive. Gold isn't a growth asset, it's protection against political and legal risk. When reserves can be frozen or restricted, neutrality matters. This doesn't signal a return to the gold standard, and fiat currencies aren't disappearing. Governments still need monetary flexibility. What's changing is the structure of trust. The dollar still dominates global trade and settlement, but dominance erodes at the margins. It fades when countries diversify settlement currencies, when trade moves into local units, when alternative payment systems grow, and when reserve managers reduce incremental exposure rather than selling outright. None of this requires collapse. In fact, it works best when it happens quietly. That's why the repricing began before public discussion caught up. And that's why early 2026 matters. Markets price expectations, not history. Attention has already shifted toward inflation data, labor reports, and the path of interest rates. As expectations for future easing build, the currency responds. When the Federal Reserve signals cuts in an environment where fiscal discipline is already under scrutiny, the dollar reacts. Each adjustment reinforces the next. This isn't about the dollar failing, it's about its dominance becoming conditional, and that distinction is critical. This is not the end of money, not the collapse of society, not the disappearance of the dollar from daily life. It is the end of unquestioned dominance. Global repricing is not a forecast. It is a process already underway, driven by debt arithmetic, geopolitical risk, and capital behaving exactly as it always does when certainty fades. The dollar is more than a currency. It's the price of trust in an entire system. When it weakens in a broad, sustained way, it signals that the market is reassessing that trust. What made 2025 different wasn't just the size of the move, but its breadth and persistence. The dollar weakened across both developed and emerging markets at the same time, despite the US remaining the world's largest economy with the deepest capital markets. That combination doesn't occur in a stable dominance cycle. It happens when relative advantages narrow and risk is recalculated. The forces behind this shift are structural. US debt has grown faster than economic output for years. Deficits are no longer tied to crises. They persist during expansion. Markets may not judge, but they account. When liabilities grow faster than productive capacity, currencies eventually reflect the imbalance. At the same time, the US growth premium has narrowed. Investors once accepted currency risk because returns compensated for it. As that premium compresses, capital becomes more selective. And selectivity undermines dominance. Policy unpredictability compounds the issue. Trade restrictions and sanctions introduce non-economic risk into financial decisions. Currency markets are especially sensitive to that kind of uncertainty when it comes from the issuer of the world's reserve asset. Hedging behavior reveals the shift clearly. Hedged capital behaves differently from unhedged capital. It's less sticky, more reactive, and quicker to move. In 2025, the rise in dollar hedging marked a clear break from decades of complacency. Monetary expectations reinforce the trend. Currencies move ahead of policy. Once markets believe rate cuts are inevitable, repricing begins long before any official decision. Individually, these forces might not matter. Together, they change the system's equilibrium. This is how dominance erodes, not through collapse, but through diversification, not through panic, but through prudence. Capital reallocates quietly, incrementally, and rationally. History offers parallels. Monetary regimes don't end because of one event. They end when constraints accumulate and trust weakens. Today's environment reflects that same type of stress. Not because the same solution will follow, but because the same question is being asked. Can the system's liabilities be supported indefinitely? As the dollar weakens, the effects spread across asset classes. Equity gains can be erased by currency losses. In 2025, many foreign investors learned that strong nominal returns did not guarantee preserved purchasing power, that experience changes behavior. Reduced foreign demand increases reliance on domestic buyers. Greater reliance increases sensitivity to monetary policy. Sensitivity amplifies volatility. None of this signals imminent collapse. It signals transition. The dollar remains dominant, but no longer unquestioned. Markets are now focused on what it must justify going forward, not what it once was. Data, policy decisions, and geopolitics will act as confirmations, not causes. The repricing has already begun, and once markets start testing a new regime, they rarely return to the old one unchanged. For decades, global portfolios were built around a simple assumption. The United States was the only real destination for serious capital. Money flowed there not only because returns were attractive, but because alternatives were viewed as either unsafe, illiquid, or politically fragile. That hierarchy is no longer intact. Not because other markets have suddenly become superior, but because diversification has regained strategic value in a world where risk is no longer confined to the periphery. The most important shift isn't happening in speeches or policy announcements. It's happening quietly inside allocation models, where institutions are rethinking what neutral really means. Large investors are no longer comfortable treating dollar exposure as a default setting. Currency risk, once ignored, is now actively managed. Hedging costs, sanction exposure, and policy unpredictability are being priced into decisions that once assumed stability. As a result, capital no longer concentrates automatically. It rotates. That rotation matters more than a sharp sell-off ever could. Persistent, incremental reallocation reshapes demand over time. This is why the dollar doesn't need a dramatic decline to lose influence. A slow shift in baseline behavior is enough to change the structure. Trade patterns are evolving in parallel. More transactions, particularly among emerging economies, are being settled in local currencies or alternative arrangements. This is not an effort to replace the dollar overnight. It's a pragmatic response to efficiency, cost, and risk management. When firms can reduce exposure to currency volatility or political constraints, they do. Over time, those marginal choices accumulate and financial infrastructure adapts. The dollar remains the primary settlement currency, but its exclusivity is fading. That distinction is critical. Exclusivity created leverage. As options expand, power diffuses. This same logic explains the renewed prominence of gold. Its role is not ideological or nostalgic. It is functional. Gold offers neutrality in a system where financial assets increasingly carry political conditions. Central banks are not buying gold because they expect a return to a gold-backed world. They are buying it because gold cannot be frozen, sanctioned, or devalued by policy choice. In other words, it is insurance. The fact that a portion of this accumulation appears undeclared reinforces the point. Discretion preserves optionality. Transparency invites pressure. When reserve managers choose discretion, they are signaling caution about the system itself. These changes are also reshaping market psychology. For decades, the dollar benefited from an automatic safe haven bid during periods of stress. That reflex is weakening. When geopolitical tension rises and capital does not rush unconditionally into dollar assets, it signals a shift in perception. Safety is no longer assumed, it is evaluated. As that evaluation changes, the dollar's premium compresses. This does not imply collapse, it implies normalization. A system where no single currency enjoys unquestioned dominance is inherently more multipolar. Influence is distributed rather than concentrated. That introduces volatility, but it also reduces fragility. This transition matters most because it is no longer driven primarily by governments. It is being driven by markets. Governments can talk about alternatives for years without changing outcomes. Markets, once convinced, adapt and rarely reverse. Nowhere is this clearer than in reserve behavior. Through 2025, gold overtook U.S. Treasury securities as the most important reserve asset held by central banks globally. That shift carries weight because central banks act defensively, not emotionally. Their goal is balance sheet resilience, not return maximization. Treasuries dominated for decades because they offered liquidity, yield, and assumed accessibility. That assumption has weakened. As foreign official demand becomes less reliable, treasuries rely more on yield to attract buyers. Yield-driven demand is inherently more sensitive to policy expectations and volatility. Gold, by contrast, does not depend on policy credibility or yield. Its value lies in detachment. That is why central banks are willing to accumulate it even at elevated prices. They are risk-sensitive buyers, not price-sensitive ones. As reserves diversify, the broader system changes with them. Structural demand for any single currency declines. Crisis responses become more distributed. In the past, stress funneled capital almost reflexively into dollars and treasuries. In a more diversified system, stress produces a wider range of outcomes: gold, alternative currencies, regional assets. This is what a multipolar financial order looks like in practice. It is not clean or predictable. It is adaptive. Timing now becomes critical. Markets do not move because a structural argument exists. They move when catalysts align with positioning. This is why early 2026 matters. Inflation data, labor reports, central bank communication, and fiscal signals converge in a compressed period. When confidence is already conditional, that convergence amplifies reactions. By late 2025, markets had largely accepted that relentless dollar strength was over. What remains uncertain is the pace of adjustment. Inflation outcomes will shape monetary expectations. Labor data will test the resilience narrative. Federal Reserve communication will be dissected for implication rather than instruction. Fiscal developments will feed into perceptions of sustainability. None of this requires a crisis. It only requires confirmation. This is why framing the moment as the end of the dollar is misleading. The dollar is not disappearing from trade or finance. What is ending is automatic dominance, the era in which leadership was assumed rather than earned. The dollar is moving from singular authority to conditional leadership. It remains central, but it is no longer alone. And this transition does not need chaos to be real. In fact, it unfolds most effectively in calm conditions when markets adapt in advance. Capital is diversifying, reserves are rebalancing, trade settlement options are expanding, risk is being priced more broadly. None of these actions imply collapse. Together, they imply a reset, not destruction, but recalibration. The old framework relied on concentration and inertia. The new one favors diversification, credibility, and restraint. Once markets internalize that shift, there is no clean return to the previous equilibrium. Too many assumptions have changed. Too many portfolios have adapted. From here forward, the question is no longer whether the dollar is strong or weak. The question is whether it continues to justify the role it plays. That answer will be delivered gradually, through data, behavior, and policy choices. The scrutiny itself is irreversible, and once assumption gives way to evaluation, the global financial system does not go back unchanged. Most systems don't collapse with a bang. They adjust first, quietly, almost invisibly. Markets still open on time, screens still flicker with prices, commentators still debate yesterday's data. To most people, nothing appears broken. But beneath the surface, something fundamental has shifted. Liquidity has thinned. Positioning has rotated, and the US dollar has started to behave in ways it hasn't for decades. This isn't panic.